You created a table here of the 10 top largest companies by market cap for each of the past like 5 decades. I'm going to put it up here, and I'm going to read this from the article I pulled this from. You can see how things have shifted with each decade. By the end of the 70s, 6 of the world's largest 10 companies were oil companies. By the end of the next decade, just 1 of them was. By the end of the 80s, 8 of the world's largest 10 companies were Japanese. By the end of the following decade, just 2 of them were. At the turn of the century, 7 of the world's largest 10 companies were tech-related. By the end of the following decade, just 2 were. At the end of the noughties, we got to come up with a better name for that decade. 7 of the world's largest companies were natural resource companies. By the end of the following decade, not 1 was. 2022 seems to have marked a turning point. The COVID rallies in tech were the final spike in an amazing bull market. These are all huge companies that make the foundation on which portfolios are built. But how many of 2021's, I guess this is when the article was written, how many of 2021's top 10 will there be in 10 years' time? I'd love for you to opine on that in any way you like, but I recall from the article, 2 of your key takeaways were the trend of the next big decade was going to be emerging markets, as you just said, and commodities potentially.
Yeah, look, I think the first thing to acknowledge is that in a capitalist system, it's very hard to stay on top. People come gunning for your business. Very often governments come to pick in your pockets. And, as you get big, you get fat and lazy. One of my favorite stories of the past few months is, when Google announced it was doing its layoffs, they announced that they were laying off 27 masseuses. Who has 27 masseuses? And especially at a time when everybody's working from home. Like everybody was working from home and they had 27 masseuses on staff. Were they doing the massages over Zoom? It's, obviously you don't want to make fun of anybody losing their jobs, but, on the theme of you get fat and
that is a clear sign of bloat. Yes.
So that's why it's very tough to stay on top in the first place. But also I think, look, to your point, markets get driven by a new theme every 7 to 10 years. And that theme always falls into one of 3 categories. It's either the idea that there's not going to be enough for everybody. So it's sort of Malthusian idea, which, comes back again every now and then. It's either new markets get opened up to capitalism and everybody gets very excited. So in the 80s, it was Japan. In the 2000s, it was China. Or it's the idea that we're going to have big technological progress and that's going to drive big productivity gains and it's going to be tremendous and drive massive increases in profits. And we rotate from these themes. And my belief is, look, the big belief in the productivity gains is now behind us, and the story of the next 10 years will be the story of the integration of this global South. It'd be the story of how if you're China, you no longer need to earn US dollars to buy your commodities. You can pay them in renminbi. It'll be the story of if you're India, the fact that oil prices go up doesn't mean that your economy implodes anymore. And all of this is already starting to unfold in front of our eyes. And as people realize the long-term consequences of this, you get a re-rating of assets. Currencies go up, real interest rates go down, and real estate goes up, and equity prices go up. I think this is the story of most emerging markets for the coming decade. And look, today I think you have 5 credible central banks in Latin America. Colombia, Peru, Brazil, Mexico, Chile. 5 central banks that, for the past 20 years have done a good job fighting inflation. Today, you build yourself a blended portfolio of these 5 countries. You're going to have 11, 12% nominal yield. You're going to have 4 or 5% real yield. Do we need to overthink it? Or just look at Brazil. Right now, on Brazilian tips, you're going to earn about 6.5% real on Brazilian tips. When you know that the long-term return of the S&P 500 is around 5.5%, 6% real, do we need to overthink this? Like you got 6.5% real right there on offer. Like, just do that. It's don't need to overthink it.
Okay, that's phenomenal. Can you do me a favor? Can you just list those 5 countries again?
Sure, of course. The 5 credible Latin American countries are Mexico, Brazil, Colombia, Peru, Chile.
Chile. Okay, great. And
Credible,
right
and
now,
that also have decent decent bond markets, decent equity markets that have like proper capital markets. Because actually, if you want to dig deeper, places like Paraguay or even El Salvador have leaders that are doing a lot of very interesting things, but there's no real capital market to speak of.
got it. Okay, so at GovCall, are you investing directly in those markets? Like, are you buying their bonds? Are you buying their,
Uh, we're
equity
more,
indices?
to be honest, we've always been more um, Asian focused.
Mhm.
And, there's very attractive markets in Asia. No, we're looking to partner up with somebody, and it's going to be announced very soon to do Latin America.
To handle Latin America. Okay, great. But in both cases, they're benefiting from the dynamic that you're talking about, which is, these markets used to send their capital out
Yep.
to be stored in developed markets, and now not only are they going to do less of that, other in-region countries are going to start parking their capital in their neighbors as well, instead of
Exactly.
sending them to the developed world as well. So it's going to
Look,
basically just be this liquidity or capital flow rush in the emerging market world.
absolutely. I first went to Brazil pretty much 20 years ago. I've actually, 2005, so 18 years ago. And by then, it was obvious that China was booming and that Brazil was going to be a big beneficiary. And, I sort of had the Asian reflex of thinking, oh, if Brazil does well, local real estate will do well, because that's what happens in Asia. When the economy does well, the way you benefit typically historically is real estate. So in my meetings in Brazil, I said, oh, where's the high end, Brazil real estate, and is it in Rio? Is it in Sao Paulo? And they said, oh, it's easy. It's in Miami. And the story was always that rich Mexicans, rich Brazilians, they make their money at home and they stock it abroad. But now, following again the confiscation of Russian assets, will rich Brazilians feel comfortable deploying capital in the US, or will they now think maybe I'm just as well keeping it home? At the margin, I think you'll have more money staying at home.
Okay. And because the majority of viewers of this channel are sitting in the West, do you recommend investing directly, sort of
Yes.
like on the Brazilian exchanges in these companies versus buying an ETF on the US market that then buys these?
No, you can buy EWZ, you can buy like the US ETFs that trade on these things. They're going to do fine. But if you have the ability to buy, Brazilian tips directly, don't deprive yourself of getting 6.5% real. Now, I understand, your average retail investor isn't set up to buy Brazilian tips, but he can definitely buy, Brazilian stocks either directly there or more easily through ADRs trading in New York.
Okay, great. And then just on the commodity side, because that was the other part that you said you were pretty sanguine on. Are these the commodities themselves? Are these the producers, the explorers? Okay, how are you planning to play the commodity boom?
I own a lot of I own some of the miners. I own a lot of energy names, and the reason I do this is more true of the energy names and the miners, but these guys are huge cash flow generators today. Now, the way I look at it is, if oil stays at $80, if I'm wrong that oil goes up and oil just stays at $80, these guys are very attractively valued and generating tons of cash flow. And so I'm basically get the free optionality on the rising energy price. And I don't have to worry too much whether oil ends up the month at $80 or $70.
Mm-hmm.
Either way, these guys are generating cash flow. Either way, I'm going to get a dividend. Either way, this thing is moving higher. So I like owning a lot of the energy names. I like owning them in the US. I like owning them in Latin America. I like owning them in Australia, in Asia, in Canada. I don't like owning them as much in Europe because I worry that there's going to be sort of super profit taxes and whatever else in Europe.
Yeah, and I forgot to mention this question earlier, but when you were on last time, you were pretty pessimistic about the returns on deploying capital in Europe, and you were kind of like, look, I'm not planning on doing it anytime soon. Has that outlook changed at all for the better or worse since you and I last spoke?
I have actually deployed a little, basically since China reopened. To be honest, I think a lot of businesses in Europe do benefit from China's reopening.
But had China not reopened,
social.
you probably wouldn't have done that.
Well, if China hadn't reopened, I think Europe would be completely stuffed. You know, Europe needs emerging markets to grow. It's lost Russia as an important market. So if it lost Russia and China, I think those are, you know, I don't know how Europe would still be left standing. So no, look, the European reopening is a big deal for Europe. And when it became clear that China was reopening, I started buying Europe again.
Okay. Louis, this has been great. I sort of synthesize what you've said, and investors are oftentimes told, invest in what you know. I take a little bit from what you're saying. If you're an American or a Westerner investor, you would be saying, actually, maybe don't follow that advice so much, right? Like, look at some of the stuff you're less familiar with, because there's a great story going on there in the rest of the world.
That's, it's, you should always invest in what you know, but there's nothing to prevent you from knowing more stuff. So yeah. Go out, do your homework on the various emerging markets, because that's where the opportunity set is going to be. There's no reason you can't find out more about what's happening in the rest of the world.
All right, that's a great way to put it. All right, so as we begin to wrap up here, Louis, for folks that have really enjoyed this conversation, again, thank you for giving us so much of your time here. We ran over a little bit. Where can people go to follow you and your work?
The best thing is to go to our website, gavekal.com, GAVEKAL.com. I don't really do much on social media. So yeah, that's the best place. We have obviously our institutional research arm. We have a money management arm, but we also have a private wealth arm. And through the private wealth arm, we do publish a lot of sort of free newsletters. So you can definitely sign up for those. If you're an institutional investor, definitely sign up for a free trial for our institutional research. And we'd love to hear from you.